guys, and welcome back to my YouTube channel. In today's video I want to address some of the things that could potentially stop you from obtaining a mortgage. I feel like recently especially lenders are continuously making it harder for people to actually obtain a mortgage. They're making you jump through countless hoops in order to actually be able to get your hands on the money. Well, metaphorically, because the money actually goes to your solicitors, but that's for another video. I personally hate long introductions, so let's just jump straight into the video. So the first thing that could potentially stop you from getting a mortgage is actually the fact of recently changing jobs. So if you've recently changed jobs and you've been in it less than 3 months, let's say, you will struggle getting a mortgage, as every single lender will want to see at least 3 months pay slips. As well as that, you may have a probationary period at your current position, which nowadays tends to be as long as 6 months. And if that's the case, once again, your lender may make you wait until you've actually passed your probationary period before granting you a mortgage. This also applies if you recently went self-employed. Once again, lenders will want to see track record of your self-employment, and it's even worse because they'll require at least 2 years of accounts as well as projections. So you may find it a lot more difficult to actually obtain a mortgage if you have recently went self-employed. Also watch out if you are currently on a temporary contract, or if you do actually prefer temporary contracts, as once again, despite it being a modern way of living nowadays, and a lot of people choose that as their career path is to do more temporary work in order to gain more variety, lenders don't like it. And if you are on a temporary contract, 9 times out of 10 they probably won't lend the money to you, especially if you are a sole borrower, unless you are actually on a fixed term contract and you have already been in it for at least 12 months and you can actually prove an extension of this contract via your employer. Now, the second thing potentially stopping you from getting a mortgage is the fact that you can't actually afford the mortgage. Now, what that means is lenders have 2 ways of actually determining whether you can afford a mortgage and how much you can borrow. The first one is an income multiplier, which basically tells them the maximum amount of money they're willing to lend you based on your income. But they do also have a second check, which is actually an affordability check, which is the one that people tend to fail on more often, as what it does, it actually looks at your regular outgoings, and that includes all your debt, any credit cards, any loan repayments, anything like that. It takes all of that into consideration in order to determine how much you can actually afford to pay on a monthly basis. And what you need to bear in mind is lenders must stress test, which means that they must take into account the possibility of interest rates actually going up, which could mean that your monthly payments could double. So they have a responsibility to actually ensure that should that happen, you're still able to afford your monthly repayments. Number 3 is poor credit score. Now, there's 2 factors for that. One is that you've never had a credit card and you've not actually built up a credit score, which is something that you should definitely look into if you are looking to obtain a mortgage in the near future. But aside from that, the second thing that often lets people down is the fact that they've actually struggled with the finances in the past, meaning they've had either arrears or they've had county court judgments or anything like that, because that will stay on your credit file for up to 6 years, and lenders have access to that information, so they will look at it when you do apply for a mortgage. So make sure you always disclose any of those. As a rule of thumb, if you've had arrears in the last 2 years, you may struggle significantly in obtaining a mortgage. That's why I would always recommend speaking to an experienced mortgage advisor, as they'll be able to find a lender who is able to take that into consideration when assessing your case. Now, if you haven't already, I would always recommend to actually check your credit report, not just your credit score, but but your actual credit report, just to ensure that there's no nasty surprises there. And if you have watched one of my videos of the 6 must-dos before applying for a mortgage, you will actually hear my story about what happened to me when I was applying for a mortgage. And trust me, you do not want to be in that position. So always get ahead of the game and just request your credit report, which you can do for free. I'll pop the link down in the description box just so you can do that, as it'll tell you everything you need to know, and you'll be able to see what the lenders actually look at when assessing your case. Number 4 is too much debt. There's so many offers out there, 0% interest on this, 0% interest on that. It's all debt at the end of the day, and lenders look at it all the same. So if you're looking to apply for a mortgage in the near future, try and pay off as much of your debt as possible, whether it be buy now, pay later agreements, whether it's credit cards, or even personal loans. If you can overpay on those as much as you can, so that you've got as little debt as possible before applying for your mortgage. The reason for that is when lenders look at the amount they'll be able to give you, as well as when they carry out the affordability assessments, they will take all of that into consideration. So for the income multiplier, they'll actually look at the whole outstanding balance and actually remove that from the amount that they're willing to lend you. And from an affordability assessment point of view, they will actually look at all your monthly repayments and add them all up, which will significantly reduce how much you can actually afford on the monthly basis, which will once again determine how much the lender is willing to give you. This is especially important if you are buying on your own, because it's only your income being taken into account. So the more available income you've got, the better. Now, I might get some backlash for number 5, but it has to be mentioned because it is a big factor in determining how much you can borrow and what you can afford. And that's having children, because let's face it, having kids, especially nowadays, is extremely expensive, and lenders do require you to input a lot of information when it comes to your dependents in terms of how much they're actually costing you on a monthly basis. So whether that's childcare, whether it's just keeping them alive, basically, they do take all of that into consideration when assessing how much they're willing to lend you. So that does mean you could potentially fail their affordability assessment just because of the extra outgoings that are associated with having kids. So if you are currently childless, stay that way until after your mortgage. I'm joking. Do what you want, but do keep that in mind. And the last thing I want to discuss that could potentially stop you from obtaining the mortgage is not something you can really control, is going for an unmortgageable property. And that's ultimately out of your control, because you won't know this until the lender carries out a basic valuation. So what you'll find is certain properties are actually deemed unmortgageable by lenders, and that could be for a variety of different reasons, with the most common being subsidence or Japanese knotweed. But as I said, there are plenty more different things that will determine whether the lender is actually willing or able to lend on that property. Because what you have to bear in mind is that property is ultimately their security. So if you fail to make your monthly repayments, they have to sell that house in order to be able to get the money back. If their potential buyer actually finds out that there's something wrong with the property, it'll make it a lot more difficult for them to sell it, or they'll have to sell it at a much lower price, meaning they can lose money. So unfortunately, there's no avoiding this. You may set your heart on this property, which to you looks absolutely fine, and it isn't until the lender carries out a valuation that you actually find out what is potentially wrong with it. Now, just something to bear in mind on this one is that when you go for a mortgage, when you apply for a mortgage, the lender will always instruct a basic valuation to be carried out on the property to not only determine the actual value of the property, not one inflated by the estate agents, but the actual property value based on what's in it, but it will also highlight anything that's wrong with it, things that can be kind of seen with the naked eye rather than having to get further reports done on it. So the likes of Japanese knotweed or subsidence are normally ones that you can actually see straight away if you're a qualified surveyor. But from your your point of view, what you need to remember is the basic valuation is for the lender's benefit, not your benefit as such. So if you're wanting to know anything specific about the property, or you're wanting to know whether there are any major repairs required, or if there is anything structurally wrong with the property, you may want to opt for either a home buyer's report, which will let you know about any major repairs that are required, or go as far as getting a structural report, which will actually tell you everything you need to know about how structurally sound or unsound the property actually is. They are more expensive than obviously just going with the basic valuation, which in some cases is actually free. However, it's definitely worth spending that money just so you've got peace of mind that you ain't gonna have to fork out thousands of pounds further down the line. So that is it for today's video. I hope you have found it useful, as not many people realise that you can actually be rejected for a mortgage, and it happens more often than you think. So definitely have a look at the things that I've discussed in this video in order to maximise your chances of actually obtaining the mortgage first time. If you do require any specific advice, please do get in touch with an experienced mortgage advisor, or feel free to drop me an email and I will put you in touch with one, as it is vital that you explore all options when looking for a mortgage. And on that note, if you like the video, please give it a like and also subscribe to my channel down below, as it really helps my channel to grow. Thanks for watching, and I'll see you back on Monday with a brand new video. Bye guys!